Now that we have understood this, how can we make a profitable trade? The profitable trade, after understanding the candles, the patterns, technical indicators. Now I put all this knowledge and try to understand where do I enter, where do I exit, and how do I put a stop loss if my direction is not right. Now that is where your risk analysis, you should know when you are bringing in, what kind of money am I bringing in, what kind of money am I ready to lose. When you ascertain the risk, when you define your risk, you're able to decide at what is a best bet to take, what is a bet that you are leaving is better. You don't take up that risk, that is better. So that is what decides, whenever there is a signal. Now that we have understood so many signals, we have understood so many trend reversals. Now whenever there's a trend reversal, decide where does it end, where does the trend reverse again, that is your stop loss. Yeah. And once you have taken the position, then the market goes in the direction which you're talking, you need to upgrade the stop loss. There has to be a trailing stop loss. As you can see here, possibly when there are three consecutive candles, you saw that there were three consecutive candles, there is a trend reversal, and you took the position and low as your stop loss. There was a confirmation, no doubt, the market moved up, then it rallied, then you upgraded your stop loss. Yeah, again there is an up move, then whatever is the bottom, again there is a small position, you upgrade your stop loss. Like that, you keep upgrading your stop loss. Then when there is a big trend reversal, you can actually liquidate any of these places. You can actually sell. These are your trailing stop loss. This is how you will be able to, if the trend is right, you can carry your position. Whenever there is a reversal of trend, you can actually close uh, close your position, find up your position. Now the most important emotion is, what is not in your control is, first is, where to enter the market, how to define a stop loss. Sometimes, we will be compelled to take a position where the stop loss is too deep. Yeah, more than the risk reward. If I'm actually trying to make 4 rupees, my loss cannot be more than a rupee or 1.5 rupees. If I'm ready to lose about 1.5 rupees, I should be making about 3 or 4 rupees, nothing less than that. So that should be the risk reward ratio. Now what if I'm going to lose 10 rupees and the opportunity which I'm going to make is 4 rupees? Will you take it? No, it's better to leave it, let go, rather than taking such position. So that is what, when you actually chart these positions, as we are practically doing, we will understand, these points. We will understand these points, whether exit, entry, exit, all these points will be understanding. So what is the right price to enter? What is the right price to exit? Do we need a trailing stop loss, or do we exit? And to exit from losses, it's not going in my direction. Where do I wind it up? Let me tell you, as a good trader, even if you have a strike price or a success rate of about 70%, 60 to 70%, I'll tell you, you'll be a great trader. You make plenty of money, which means out of 10 trades, even if 6 trades or 7 trade goes in your direction, you're going to make plenty of money. But what decides your fortune is that what you actually do with those 3 or 4 trades, which is not in your direction. We jump even to 1 rupee, 2 rupees profit, small profits. We jump and take it when it is in our direction. But sometimes the losses, the stock is down 10 rupees, from 15 rupees, 4%, 5%. Then also we keep thinking, okay, it will reverse. Okay, it will reverse. We'll be thinking, and then we keep on running trades. Now, if there are 6 trades where you have made 2 rupees and there is one trade where you actually lost about 10, 15 rupees, what's the point? So it's your emotion which actually governs how much of money you're going to make. Yeah, whether you're going to cut your losses small, or you're going to, grab small profits and allow big losses. So this is what, this is the common traits which we see in the market. It's nothing wrong with you or me. It's the human emotion. So that is where we need to keep our emotion aside if we have to trade successfully in the market. So this is about, entry, exit, and stop loss. Now, who decides this? What kind of risk should be taken? What is the right risk to be taken? Who decides? You have to decide. You know how deep is your pocket. Yeah, how much you can afford to win, how much you can afford to lose. You decide. So that is where, you basically first decide a right entry where your stop loss is closer. Yeah, and the opportunity is much bigger. As I told you earlier, if I'm losing a rupee, 2 rupees, I should be making at least 3 or 5 rupees. If that is the preposition, then it is worth taking that call. You take that call, and I'm sure that if you follow basics right, definitely 6 or 7 times you will be right. And then you're going to make good money. But even if you're wrong 3 or 4 times out of 10 times, absolutely fine. But stick to your stop loss, because your capital, protecting your capital is most important when you're in a trading platform. So you have noticed that there is an opportunity. You have entered. As you enter, you're in the right trend. You keep putting a trailing stop loss. Then, as you can see very clearly here, now the Elliott wave theory works here. Yes, absolutely it works. The Dow theory works here. Yes, the Dow theory also. The most important is the Dow theory. Remember, in an uptrend, what are you seeing? Yeah, the higher high and the higher bottoms. The bottoms are also making higher. The tops are also, there are new tops. So that is where, then here is the breach. There is a bottom and there is a breach. Now, don't you think that this is where actually you wind up your position? Then wait, if you want to re-enter, wait for the markets to give the right signal. But this is where, whenever there is a breach, that you need to wind up your position. So when you follow this, if a new low is created, you cut your positions there. Absolutely, you need to cut your position. It doesn't matter what time frame you're looking at, whether you're looking at a 1 minute chart, whether you're looking at a 5 minutes chart, whether you're looking at a 15 minutes or a 30 minutes chart or a day chart. It doesn't matter. When a new low is created, you'll have to get out of your long position. Yeah. Similarly, when a new high is made, you have to get out of your short position. This is how basically it looks like. Okay. And then here I would like to explain some of the risk reward to you. Basically, equity provides plenty of, it offers a lot of risks and also the highest return. In India, traditionally, we have seen the mutual fund managers or the best managers giving consistently about 14 to 15% on a long-term basis, or return on a long-term basis. Yeah, there can be some years with 20-25% plus in a bull run, and there can be some years with minus 3-4% in some of the years. But when you look at a larger period, I would see that Indian equity markets multiplies money at the rate of about 12 to 15% now per annum, which is great, which is absolutely great. If your money can grow at that rate, which means you're able to beat inflation, nothing like it. Now, here are some of the risk reward. I think you already know about it, but I would like to cover this. Money market, basically the liquid funds, the money market offers least risk as well as the least returns. Similarly, the municipal bonds or the state government bonds, the treasury bonds, which are safer instrument. Also, the the risk is very low, the returns are also low. Then real estate, that real estate, people think that there is no risk in real estate. The only reason is there is no ticker. Because the moment you bought a plot, I know that you have bought a plot measuring about 50 by 50 feet, and then every day you don't go and watch, there is no price ticker attached to it. Because if you have a price ticker, definitely like stocks, you will see that somebody is already there is quoting less, then you will get panicked. So because there is no price ticker, you wait for several years, and then suddenly you find that it has grown. Let me also tell you, if equity markets in India is growing at an average of 15% CAGR, the real estate growth is much lower. It's about, you go check your records, you Google it, you find answers. It is definitely way less than that. It is anywhere between 8 to 9% or 10% at the most. Real estate doesn't grow even beyond that. You compare the two periods, the price difference, you adjust the inflation. I'm sure that it will not be beyond this point. I'm sure that one of the best instruments, so the financial instruments which is available for Indian investors is equity, is definitely investing in equity markets. Here I'm talking about wealth creation. Here I'm talking about the long-term investing. I'm not talking about the trading. I'm not talking about the trading opportunities. Now there are some stocks, and that is where, when you opt for stock options, ESOPs, basically when you work for a company which gives you shares, that's a great opportunity to make money. Then you have derivatives. Yeah, you take up a project, you do land development. There's a lot of risk. It's not just a plot. You're buying the whole piece of land and you're going to sell. There is a high risk and there is a high reward. Similarly, when we look at derivatives market, we'll be covering derivatives market shortly. When you look at derivatives, there is a huge risk because it's a leverage. Here the trading happens with leverage. What exactly is leverage? How exactly the trade happens? What is the risk involved? we will be studying as we go ahead. Now, for each of the points which I've covered here, I'll be going through some of the live sessions and I'll be giving you a lot of videos. I'll be sharing a lot of videos with you once it's done. So the point is, keep playing this repeatedly, watch it with the market, and I'm sure these concepts will sink in. First, what I want is, I want you to absorb these concepts, get this concept straight in the market, be strong with the fundamentals. Yeah. uh, as I told you, technical analysis is a vast subject. Here, it would be exhaustive if I cover you more. What I've tried to, is actually, I've actually cleared a lot of uh, subjects on the frill, which is not much, not which is on the fringes, which is not much important. I've given you the best, the essence, the essence of the whole subject, which is important and which you can apply directly. Now, coming back to the concepts which we're talking about, there are a lot of risks apart from the trading risk. There are a lot of risks when you look into. I know you would have already understood this in a fundamental analysis. There is a market risk. We don't know the trend. What is happening with the industry? Especially, you have seen that auto industry. Whenever there is an interest rate fluctuation, whenever there is a policy matter which is coming up, this whole sector, there is a market which happens. Which is an industry risk. There are certain products which is actually governed by the policies. Yeah, example, silk. There is actually silk. Suddenly there is an import of silk which happens, which impacts the whole market. There could be an industry risk. There could be a regulatory risk, because a lot of our products are based on regulations. There could be a regulatory risk. There can be a business risk, and there can be a market risk.